Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to another episode of Canadian Investing in the U.S. This week, my guest is Amit Kakar. Amit, let's tell me a bit about yourself. Let's tell me about your story, how you went from investing in Canada to investing in the States, or if you just took the plunge straight to the States. Let's go through who you are and then into your story.
Absolutely. Thanks, Ben. Pleasure being on your show here. Amit Kakar, I'm actually a chartered accountant by profession.
Oh.
I graduated at U of T and then sort of joined KPMG, articled there, and then went into the corporate world. The normal 9-to-5 rat race, as they say. In terms of real estate and the reason why we're here today in terms of my journey, I really commenced my journey by sort of acquiring my matrimonial home back in 2002, as my principal residence, where I still, actually live today. It's in the GTA. But I quickly realized that the 9-to-5 and putting what I could in RSP just wasn't enough. I just didn't feel like it's going to be satisfying the sort of successful retirement that I really wanted at the the age of 65. So I ultimately actually stumbled upon a book called The Wealthy Barber.
Yeah, I've read that.
Developed some really key basic insights into concept of just pay yourself first, leverage other people's money, the pay yourself first concept of skimming off the 10 to 20% first right off your paycheck, directing those funds to a company sponsored RSP, having the leverage of the employer portion, basically it's free money in terms of the RSP match, help accelerate the retirement. And then also the number one concept that really stood with me was accelerating it through owning one additional investment property. So in addition to having my principal residence, if I could just own one additional investment property, which is outlined in The Wealthy Barber, and having those successfully paid off by the time you're retired, could theoretically fund your entire retirement. And just with the concept of inflation and inflation adjustment, price increases, something you buy today could theoretically be worth more than millions by the time you retire, right? So the book also went into the overall life journey of finances in terms of insurance and estates and all that stuff. So it was really quite interesting, and so that's what really perked my desire to purchase that one and only one investment property. It's also
what? Sorry to cut you off, but I had this idea in my head for a long time. Like when I bought my first Canadian rental properties, that I'm like, I just need to buy these and pay them off. And I was like, where did I get that idea from? Because afterwards I got in, because I read Wealthy Barber first, and then I got into the Robert Kiyosaki, and then I got into everything. But I was always like, where did I get this idea that I just want to pay off this property? Because I was like, now I'm like, that seems kind of counterintuitive to some of the stuff, but I was like, where did I get that? And now I know where I got the ideas from that book, but I haven't read it in years, but maybe I'll have to give it another listen. But anyway, sorry to cut you off.
Yeah, no worries. Yeah, they actually came up with a remake as well to address
Returns. Yeah, I have it too.
Okay, awesome.
I'm a reader.
Yes.
I read a lot of books.
That's awesome. Yeah, so I went on to that journey of having perked my interest in buying that one property to help fund the retirement. It also helped that my father-in-law was also an investor. So post-marriage, I was constantly berating him with questions. I was really scared to take a plunge. Paralysis by the numbers, if they say. I forget the actual term.
Analysis paralysis.
Yeah, exactly. That's the one. And so, leveraging his knowledge and just helped me build the confidence over the years to actually take the plunge. So I, essentially started in the Toronto condo market back in December 2007. I bought sort of my first condo at Front and Spadina. It was a resale. The classic city place condos. And my strategy, ever since has really been buy and hold. As you say, it's kind of counterintuitive, but it is sort of just strictly.
No, it will work.
Yeah. It's just strictly pay them off and sort of substitute my current paycheck with this passive real estate check. So once I get to that threshold, whatever that number is that can replace my current income and my current lifestyle with the passive cash flow is sort of my goal, right? And I look at sort of, in all honesty, the appreciation as really being the icing and not the cake itself. So for many investors I know out there that it's kind of the reverse, but I'm all about the slow, safe and steady mindset. And the number one objective historically was always to ensure that the rental income would cover all the cost. So no matter what kind of economic downturn that I'll have to weather, I wouldn't really care because my costs are covered. And luckily for us, we haven't really seen any bumps in the road over the last 20 plus years. But of course, no one has a crystal ball with all the printing of the money that's going on with the pandemic. There's a lot of still speculative buying going out there, so we don't know where it's going to go. So I just kind of take the speculation out of the game, and with my strategy, I don't really care if from a paper gains perspective whether the property values go up or down. It's just sort of I'm sort of I don't even care about that sort of aspect. Overall, I plan to trade my time that I earn money from my 9 to 5, which we really all know that isn't really a 9 to 5, to ultimately allowing my money to make money and my time becoming my own. And like I mentioned, just getting out of that rat race concept. Ultimately, I quickly learned that I was now not only paying off. So once I acquired that one property, I quickly realized that my 9 to 5 paycheck was not only paying off my mortgage, but now I was able to leverage my tenant's paycheck to leverage a second mortgage. So I was really simultaneously now paying off 2 mortgages without needing to work harder or do anything different. So it's like kind of a multiplier effect. And so then I started thinking, I was like, why stop at 1? And it really became a true passion to grow the portfolio year in and year out. I ultimately bought my second condo downtown exactly 2 years later in September of 2009. That one was a new build. And I leveraged my principal residence. By the time between 2001, when I actually acquired my principal residence, to now, I'd built up quite a bit of equity through natural appreciation and the overall pay down of the principal. So I leveraged that to buy the second and sort of the third properties, which was acquired again another 2 years later in 2011. And then I got really aggressive. And then I was like, okay, now let's think about geographical diversification. Let's think about really taking this to the next level and getting out of the rat race well before 65. And at that same time, there was that financial crisis, and I saw prices in the US that were really depressed starting to bottom out. But what actually really intrigued me was the fact that foreign exchange rates were at par or even more favorable to the Canadian dollar for the Canadian dollar. So it was just, I thought to myself, this is a no-brainer. Even if FX rates, there's no way FX rates can stay at par. Let's put that out there for a second. And if anything, it would drop 20 to 30%. And so that would be an easy win for me. Even if nothing else happens to prices, they stay at this bottom for the next 20 years. In some past crises, it took the market to recover many years, right? So I thought to myself, even if that happens, it's okay. And I thought to myself, then the next question really came, where to invest in the States. And as being from Ontario, we always thought about the snowbird destination being the classic Florida. And in my mind, that was the only really place to go because that's where every Canadian goes. And so around that same time frame, interestingly enough, I was just vacationing with the family in Cancun, Mexico, staying at a resort called the Moon Palace, where I was actually, and part of that Moon Palace package included a round of golf. And I actually like to think of myself as an avid golfer. And we got paired up with a couple, an elderly couple that were from Alberta, that just happened to be vacationing out there at the same time. We paired up and became a foursome from a golf perspective. And we started talking, and they mentioned to me that because they're from the West Coast in Alberta, that their snowbird destination is Phoenix, Arizona. And I was just an eye-popping experience. I had no idea. My eyes were wide open at this point. I was like, there's a whole nother U.S. snowbird destination. And so I got back from the vacation, started researching right away, and really comparing, because I really knew I had to take advantage of this market. One way or another. And so it's whether Florida or Arizona. So I narrowed my 2 markets down, and now it's just doing an apples to apples comparison. And what really came apparent to me from a risk mitigation perspective and fundamentals was, what would be my cost? Because again, I'm very conservative. Right, relatively risk adverse, although now people would probably think not so. But my whole thing was, with this crisis, if I don't find a renter ever, what is it going to cost for me to hold this property? What is my sort of standby cost? And in Florida, I realized that it's going to be closer to the $600 to $800 range, given the higher property taxes, the higher home insurance, higher HOAs, the homeowners association fees. I just felt that those costs relative to Arizona, when I was comparing them, were much higher. And I think part of that, the answer to that is maybe the cities in Florida that I was looking at were more risk adverse to potential natural disasters such as the hurricanes and so forth.
So which way were you comparing, like the Miami, Orlando's, or what was
Correct.
your?
Yeah, more Miami. It was Sarasota,
Yep.
because of retirement community,
Yep.
and so forth. And so, yeah, I really didn't get to that point of really narrowing it in too much.
Yeah, no.
But I just knew that when I was looking at some properties and going to these seminars and they were trying to break down the costs, that the vacancy cost would be X amount in terms of a fixed cost. And when I looked at Arizona, my property tax would be $100 a month, or $1,000, $1,200 a year.
Yeah.
My insurance was going to be $50, and my HOAs were $50, so $200, and that's all I had to incur. And the worst natural disaster there was a sandstorm. I was like, I think I could weather a sandstorm. And I guess the only other cost in Arizona I found was, the air conditioning malfunctioning, just because of the extreme hot weather there. But
yeah,
all said and done, I decided that I needed to take the plunge, and the plunge would be in Arizona. So again, to mitigate my risk, not having been in that U.S. market, it's a brand new world to me. And like you mentioned, there wasn't a lot of information out there except for these seminars and really folks trying to pitch their own bias, right? In terms of, us coming along to their journey. I thought to myself, I got to start my own journey. As much as I hate to, reinvent the wheel, there wasn't really much of a wheel out there to start with. So, so I again, with the concept of further mitigating my risk, I partnered up with in a joint venture for like-minded individuals here in Canada, and we took a flight out there. We got some referrals from an agent here in terms of some folks that they have contacts with in Arizona. So we leveraged that contact. It was a RE/MAX agency out in Phoenix.
Yep.
So we called them. They lined up a bunch of listings for us to view, and there was still a lot of concerns, and I try to mitigate a lot of my concerns in the U.S. market. One of them being cross-border taxation. Another natural concern was the fact that the U.S. there's a lot more litigation from tenants. At least that's what I was always worried about U.S. How much litigation there's out there on every little thing, right?
Yeah.
So how do I mitigate that? Those are probably the two key risks for me, and also understanding what the rental markets were like over there and what I could really fetch in terms of rent versus the cost, right? And making sure that percentage was reasonable. So anyways, in 2013. 2012, we ended up buying 2 properties out there in a span of 4 months.
Yep.
And in 2013, we acquired another 3. And ultimately, that's sort of where we stand today. And now I'm kind of at the crossroads with my portfolio in terms of, thinking about revisiting my structure. When we start out this journey, we don't think about certain things. And we grow too fast, too soon. And then now you got to kind of think back and revisit the structure you bought these in, because a lot of these things I bought my properties in were in my own name.
Yeah.
Revisiting sort of my insurance policies, making sure that I mitigate the risk from that perspective. And then now the reason why you and I connected, as I mentioned, having heard you on the Andrew Hines show, and your great show on sort of Canadians investing in the U.S. market, I thought, why don't I leverage your expertise and knowledge in other markets, given that I don't see an opportunity in Phoenix right now because it seems to be a little frothy.
Yeah.
There seems to be a lot of supply shortage in Phoenix and maybe across the U.S. I'm not sure.
Yeah.
But those are some of the reasons why I want to reach out to you, is really pick your brain on terms of what markets are lucrative for us here Canadians to still with from a percentage of rent to the cost of acquiring a U.S. property. So yeah, that's the story in a nutshell.
Cool. I have a couple questions I wrote down as we were talking. So I'm guessing these were cash purchases because you didn't have many other costs, right?
From a U.S. market perspective or Canadian?
Well, when you're buying your properties in the U.S., right? You bought those 2 and then you bought the 3.
That's right.
I'm guessing those were all cash because you were saying your expenses were so low. I didn't hear any mortgage in there, so I'm guessing you did cash on that, right?
So when we bought our first one, it was correct, all cash.
Yeah.
And then we got to start talking to a bunch of folks out there. I was just really cold calling every bank I could think of. And I came across, and even leveraging real estate agencies and so forth in terms of how other Canadians are doing it. And I came across a lender that was willing to give us 50% loan to value on our second property.
Okay.
So we put in 50% more cash to acquire the second one, and then we leveraged that same bank essentially to buy the next 3 as well. So we've got 50% loan to value out there. I mean, of course, the interest rates were astronomical.
It's a
I
little
think
different back then, yeah, because they
yeah.
had to. It's a lot of risk back then.
That's right. Yeah, and we're considered, as Canadians to the U.S., we're considered aliens still.
Yeah.
We probably still are today. And we were, my interest rates on the first few, I think, were at 6.25 and 4.75 now. And coincidentally, I just called the banks just this week, given the low interest rates, historically low interest rates, and they're willing to work with me to further bring the rates down to a few basis points down. So that's great news for us.
Yeah, that is great.
Yeah.
So, did you do like a cash out refinance, or you stuck with those original loans?
Yeah, we haven't really gotten creative out there yet, and that's why we're here today. So now that we've built a lot of equity, the properties I purchased out there were in the sort of the 120 to 160 range.
Yeah.
And again, remember, I bought them at par with Canadian dollar. So now, if you consider foreign exchange plus the appreciation, these properties are well over worth. If you think about it, buying them at par was 100,000, 150,000, say Canadian.
Yeah.
Now that same property with FX is worth well over, north of 300,000.
Yeah.
Yeah. So they've done quite well over the tenure here.
Yeah.
So now it's time to see if we can leverage those funds and the equity, do a cash out, whether it's a cash out refinance or just create a line of credit,
Yeah.
And kind of go shopping again.
Cool. And then for your for your properties down there, I'm guessing you're using a property management for that whole thing?
Yeah. The Remax, we're leveraging
Okay.
Remax. Yeah, 8% generally.
Yeah, okay, that's good. That's a typical rate, is usually
Yeah.
8%. Sometimes they try and stick you with a 10 when you're new, but yeah, 8's
Mhm.
pretty typical sort of rate. I haven't done any Arizona investing myself. I was just curious, like, can you raise the rents whenever you like in Arizona, or is it on renewals, or is it when tenants leave? Because I know different states are different ways.
Yeah, so that's a great question. So one of the reasons that, again, I went to Arizona and part of my comparison was, in fact, making sure that they were landlord friendly.
Yeah.
And what I found was the eviction process in Phoenix was really landlord friendly. And in terms of answering your question on the rents, generally at every renewal stage, you can raise the rents to whatever you want, whatever the market will bear and whatever the tenants are willing to bear. So it's definitely rental increase. There's no sort of set amount that you're capped to, anything like here in Ontario.
So if your properties have doubled in price, have your rents sort of kept up with that kind of ratio, or is it not quite?
No, well, I mean,
I know it's pretty hard to do that.
Yeah, no. So it's a fair question. So I think we started out rental rates around about, I'd say 1,100 to 1,200 a month. Actually, not even. I'd say 1,095 was probably the first rent, and that same property now we can kind of fetch about 1,600 now. So 60% increase. Although property values have gone up, 300%.
Oh, yeah. Everything. You bought anything back then, you did okay.
But what's interesting now is that not only are there no supply of properties in Phoenix, but there's no supply of rent. So we actually just had a vacancy come up last month, and I kid you not, it was rented for $1,450, and it got swooped up in a day when we listed for $1,650. It was just that tenant was only there for, I want to say 2 years, and good sized appreciation on the rental side. So there's definitely a huge uptick. Like, I could see these properties renting out for $2,000 each very quickly.
Yeah, well, that's good whenever it swoops up that fast. I wasn't sure if you're going to go the other way with it, but that's really good. That's a hot market, right?
Yeah, exactly.
Yeah. I don't know. What else do I need to know about Arizona? I haven't done much stuff. I haven't done anything in Arizona. I haven't even been to Arizona. So you went down there and toured these at least, right? So
yeah, definitely. We sort of, when we met that contact over the phone, we just asked them to line up some investor-friendly properties, low cost basis. It's just our first entry point. So that's how we kind of started. And then every time we go back, we kind of stay in Scottsdale because it's really the hot vacation spot and great hotels out there. And then we sort of go on to the suburbs because I found Scottsdale is the epicenter, but property values are more conducive to maybe personal residences as opposed to investments. Although a lot of people do invest in Scottsdale as well. But we found going into the suburbs, similar to like a Mississauga, an Oakville, kind of suburb relative to where we are, would be probably the best where we want to invest. And that's what we did. So, 30-minute drive into Scottsdale, into the epicenter, we're sort of our location point. So, we bought in the counties of Maricopa, Glendale, Avondale, El Mirage. So these are the suburbs comparative to other suburbs like the GTA, if you will.
Yeah.
Outside of Toronto, yeah.
And then for these kind of suburbs, you mentioned HOA fees similar to Florida. So I'm guessing they're one of those cities or states that loves the little communities.
Yeah, exactly. Yeah. So we were very new to that concept, but when we got to thinking about it, we thought, hey, this is a great way for the preservation of our investment. These homeowners associations, there's these folks that are driving around our neighborhoods, making sure that trash cans are not visible, people are not randomly parking on the street, making sure that the painting of their exterior brick colors, the landscaping is all adhered to certain bylaws of the municipality is actually a great thing. So let's pay that $50 a month and let's not worry about it. It's actually maintaining the appreciation and the value of our homes, and it's a positive thing ultimately.
Well, and $50 a month is nothing.
Yeah,
It's
exactly.
Whenever you get into some of those like Florida ones, they're like $400 a month. You're like, what?
Yeah, exactly.
Because but sometimes it includes, like, we were looking at some in Tampa, and they're like, includes access to the water park. It includes golf course fees, but you're like, this is for tenants. Like, this isn't for me.
Exactly.
So you're like, this doesn't work for me, right? And so like, oh, it's an interesting thing. When you're also dealing with HOAs, I know some of them will not allow Airbnb. I'm guessing, have you looked into that sort of side?
No,
of it?
that's funny. So I'm actually looking into that next. I've always been a view of long-term investment, long-term tenant, sorry. So I haven't really thought about Airbnb. So my next call out this week actually will be to call the HOAs where each of my properties reside and assess whether Airbnb is positive or applicable there or not.
Yeah, because then you have some personal perks to it too. Like you could technically, instead of staying in a hotel, you could stay in that place, right?
That's right.
Whenever you go to visit for a week or whatever. Yeah. No,
sure.
So that's awesome. Well, whenever we can, if you actually want to go to the States right now.
Yeah, exactly. Yeah, we're probably, we definitely do for a trip because we do definitely want to go shopping, as I mentioned. So once the borders open up again, I'm hoping to leverage some knowledge from yourself, leverage some other contacts and from realtors in different markets, and then start that process of acquiring the next few in the US and growing that portfolio. Yeah.
Cool. If anyone wanted to get a hold of you, what's the best way to do so?
Yeah, probably email. And my email is for my first initial underscore my last name KAKAR @hotmail.com.
Perfect.
Yeah.
So if you're interested in Arizona, give him a message and see. Happy
to provide a sort of even a evaluation of one of your deals if there's anyone out there that's looking for some sort of evaluation. And then just any information, whether it be about the US or Canadian market, happy to support any of your viewers and their needs.
You also said you're an accountant. Do you do like the cross-border CPA?
I actually don't try. I try not to mix sort of my personal and my taxation, even though I could theoretically do it.
Yeah.
Just because you may be aggressive or too conservative, you always want that separate set of eyes, I think.
You know what? I totally respect that, because I totally believe that if you do fewer things, you do a much better job at it. If you start saying you do everything, you're like, you're here, you're there, you're kind of in it. You haven't read all the journals and everything on every topic. Yeah. And I totally appreciate and respect that mentality to it.
Yeah, and I think one thing I am working on is grabbing my mortgage agency license. So I'm actually working on that. And eventually I think I'll probably get my realtor license as well. So almost creating a one-stop shop is sort of
in Canada, right? In Toronto.
In Canada, in Toronto.
Okay. Yeah. Cool. Well, thanks so much for coming on the show. I
Absolutely.
Really appreciate it.
Yeah, it's great meeting you as well. And happy to jump on future episodes or whatever you're interested in chatting again.
Yeah.
Maybe we can explore my next. Yeah, maybe I can come back on and we can explore sort of one of the next properties I purchased or something, and just do a sort of a number crunching, 10-minute quick episode or something.
Yeah. Oh, I think that people would love that.
Yeah, absolutely. Okay, great.
Awesome. Thanks.
Thanks, Glenn. Take care.